And for more on the new housing regulations, which do aim to prevent a repeat of the housing collapse and the financial crisis that followed, we're joined by Shane Siederman, partner and advisor at Bay Ridge Financial Group. Shane, thanks for joining us tonight.
It's a pleasure.
So Shane, as of today, lenders have to verify that borrowers can indeed repay their home loans. Now, to me, that seems pretty basic. Shouldn't this have been the case before anyhow?
I believe if it was the case before, we wouldn't have done so much damage to the U.S. economy. I believe now that they've finally got their act together, although sometimes it looks like it's going to be rougher getting a mortgage going forward, it'll be more cut and dry, black and white.
The ability to repay, that is the clause in the new regulations that has housing advocates and some lenders, some banks, a little bit up in arms. Explain what that means exactly. How has that changed? How are they going to verify that you do have the ability to repay your loan? And how is that different from how mortgages were issued previously?
I think to put it in street language, you could go past the cemetery, dig up Skeletor, and he could get a loan. I think
that was prior to 2008.
Yes.
Lately, it hasn't been that easy to get a loan at all.
Absolutely. I couldn't agree with you more. But in the last year, 2 years, just getting any kind of loan is very tough. So even though the black and white finally hit the print and it's wet and it showed up finally, the last year the banks have been acting way ahead of that. They knew the new regulation was coming down the pipe. That's what they pay lobbyists for to go to D.C. And so a lot of these implementations already happened. In other words, you're not going to see an mortgage interest that could go up where they're only paying their interest and not knocking down their principal. And I think that's key moving forward, too. What
about the qualified mortgage? Because that seems to be a carved out section in this regulation. What does that mean exactly?
What that means is if you're paying they're going to put down on the bills what your monthly bills are. What's your rent? What is your heat, your cell phone bills? And they're going to look at all your bills and what the monthly, so let's say the bill came up to $10,000. They're going to look at your debt to equity, and it's going to have to be greater than 43%. So just to give you an example, if you took $10,000, we're in New York City, so we're going to use a higher fee than most countries. Okay. If you took $10,000 a month times 12, that's $120,000 worth of debt. To get a mortgage, just to qualify to get a mortgage, you would take that, divide the $120,000 divided by 0.43 or 43%, and you'd have to, I think it's about $279,000 in gross income just to qualify for the loan. So you could see they're going to really do their homework this time, where in the past, you didn't have to do that.
What about the concern now that lenders will only now give mortgages to people with spotless credit? A, what impact does that have on the housing market? And what does it mean for lenders with regards to their business?
Well, it's going to be tough. There's going to be less lenders out there. You're seeing the U.S. market last year did extremely well in the real estate market, but it did because a lot of big institutions came in. And there are problems out there. I'll give you an example. I have a friend that's a physician assistant, and that's what he does for a living. He's an executive at a large healthcare company. Right. Doesn't matter which one. And he makes a very good income, but during this mess, he bought a business for almost $1 million, and it had a building in it. And he foreclosed on it and went bankrupt. Now, this guy might make almost a $200,000 salary. He lives in Florida. He's still not paying his rent or mortgage right now, but he's saving his money.
So are banks now going to be more reluctant to give mortgages? It's going to be even tougher for them. And what does this mean overall? I mean, mortgage applications are surely going to be on the major decline. And what impact will that have on housing prices?
Well, I think in the short term, the impact will be felt. We will see that part of the market, the consumer, still hasn't kicked in. Last year, all the money that was spent in the housing was really a lot of foreign investment, a lot of the hedge funds. It wasn't the consumer. Now, are there consumers out there with money? Yeah, they're going to have spotless credit, at least 720 credit score. If they get 680, their interest rate's going to be a lot higher than someone with a 720 credit score.
Home prices were up 12% last year across the nation.
Yes.
So do you see that declining now, or do you just see the rate of appreciation stopping?
No, I was on the phone today with Goldman Sachs, and I spoke to their people a couple times in the last 2 weeks. They said the next 2 years they expect a 4% growth rate in the real estate market.
Combined with the Fed tapering, this as well as the Fed stopping to buy mortgage-backed securities?
There, you got me on the gotcha question.
Uh-huh.
So the gotcha question is this: is the Fed really going to taper? Janet Yellen is known as a dove. We had the employment numbers come out. There was what, I believe 74,000 jobs created. That's not a lot of jobs. That tells me the Fed's going to stick around. Now, does that mean the rates could possibly go up over the next 6 months to a year? Very cautiously. I don't think the rates are going to go up anytime soon. And also remember, if the 10-year right now, which is 2.88%, I believe, if the 10-year was to go from 3% to 4%, you're talking about a 33% increase.
Okay, so then what does this mean? We've got the mortgage regulations. We've got the Fed saying it will taper, still to be determined.
This means to me that if rates go up, I think it'll be very, very gradual until we got a more solid clarity out there. And I think the Fed, every time they've pulled back the punch bowl from keeping those rates low, the market has started to come down, and that affects the global economy. We're no longer just the U.S., the powerhouse. Now it's the U.S. global powerhouse. That means McDonald's, I think their profits, 70% come from outside the U.S. So we got to remember, I don't see the Fed backing away so much, and I do see rates stabilizing. If they go higher, I don't see it huge.
All right, so overall, bad for the housing market?
No, I believe it'll be a net. Goldman's saying 4% over the next 12 months.
Okay.
I think 2%.
Okay, we're going to have to leave it there. Thank you so much, Shane Siederman, partner and advisor at Bay Ridge Financial Group.